The other aspect you need to know about for now is the liquidity ratios. So later on in the year, you'll look at stability ratios as well, and then some ratios that are specific to public companies. That doesn't come until the end of year 12. But for now, so liquidity ratios are going to communicate a business's capacity to meet short-term financial commitments. So when you think about the statement of financial position, we list our current assets and we do so in order of liquidity. So if you've got cash in hand, so physical cash, that is very liquid because it's right there. You can literally give it to someone to pay off a debt or to pay for something, to purchase something. And then next up would be cash at bank. You've got money in a bank account that you could use. And then something that's less liquid is accounts receivables, because you're relying on other people to pay you back before you then get that money in order to pay your own financial commitments. So this idea of liquidity is about how easy it is to turn the money into cash that can be used to immediately pay for something. So some liquidity ratios include the current ratio, the quick ratio, and then the rate of turnover of accounts receivable and the rate of turnover of inventories. So let's now look at each of these. So the current ratio indicates the business's ability to meet its short-term financial obligations. So short-term financial obligations are defined as debts due in the present financial year. And it's measuring this in terms of using its current assets in order to meet these obligations. So you calculate it by dividing current assets by current liabilities, and it's expressed in this ratio form. So a number with a colon and another number. So the number 1 is on the right side of the colon, and the quick ratio calculation for the business is on the left side. And the benchmark is typically greater than 2 to 1 for the current ratio. But keep in mind that benchmarks can be really different depending on the industry, because the business's activities, again, are going to really influence what is deemed standard for that industry. The quick ratio, so it's also called the acid test, and it measures the capacity of a business to fulfill its immediate financial responsibilities, so things like accounts payable, using the assets that are available really on hand, either instantly available, so they're right there, again, like cash in hand or cash at bank. The business already has that money that they can use, or quickly converted assets. So for example, accounts receivable has to be converted. The business has to get that money from the accounts receivables before it can then use it. So it's calculated by subtracting inventories and prepayments from current assets and dividing the result by current less liabilities less any bank overdraft. You're not always going to have a bank overdraft, but if there is one, it's important to subtract that as part of your calculation. Keep in mind as well with the formula sheets that you get, sometimes little nuances like that are not included. So that is something that you may need to just know, because it's very, it's rare that there's a bank overdraft. So that could be something that you just need to memorize yourself. Keep that in mind. So again, this is expressed in ratio form, again with that number 1 And in this case, the benchmark is typically greater than 1:1. So a high quick ratio is going to indicate that the business's current liabilities can be paid out of its current assets. So that's what you want. A high ratio is better. A low ratio is going to suggest that the business is relying on inventory turnover to pay short-term debts. So it's relying on selling its products in order to pay those short-term things. So it's a less stable position to be in, because if sales were to take a downturn and you weren't generating as much turnover of inventories, then you wouldn't be able to pay those short-term obligations. And of course, that would not be a good position to be in. So of course, that means that you want to decrease current liabilities, and increasing current assets would improve this ratio. So there's a whole bunch of suggestions that can come as part of this to improve those things. So if you want to improve your accounts receivable, maybe you want to, in order to address bad debts and things like that, maybe you want to offer some incentives for people to pay early or on time. You could seek out some discounts for paying your obligations early, and that can help as well. In terms of turnover of accounts receivable, this is showing the average collection time it takes for accounts receivables to reimburse the business with the money that they're owed. So it measures the efficiency of the business's accounts receivable management practices. Now you calculate it by dividing net credit sales by the average accounts receivable. So of course it's about credit sales here, is it's accounts receivable, not cash sales. So this rate can be expressed in times or days. So the number of times that accounts receivables are paying in a period, or the number of days it takes to for each accounts receivable to reimburse the business. If you've got the rate for times and you want to convert it to days, you can divide the times figure into 365. So 365 divided by the times figure. Now, a high rate of turnover of accounts receivable, so a low number of days, indicates that the business's credit policy is effective. If you've got a low rate, then of course it's the opposite. It says that the business has a poor credit policy and may be at risk of having a high amount of bad debts, of people not paying off their debts to the business. So if you've got it in times, then you want the number to be higher. If you've got it in days, then you want it to be lower. So a wide range of strategies can be used to improve this ratio. So it could improve its credit policy, contact outstanding debtors. So you could perhaps hire someone to phone, email, or send letters to the people who owe the business money, to try and follow up and prevent the debts from turning bad. It could more sort of strictly assess the creditworthiness of customers before offering credit to them to begin with. And it could also offer incentives for early payments, like I mentioned before, and charge interest for late payments. So you've got that reward for early payments, and a punishment of sorts for late payments, trying to incentivize those on-time payments. Now, turnover of inventories. So a similar idea, except in terms of inventories instead of accounts receivables. So the management efficiency of a business in terms of its inventories, how fast the inventory is sold, and the liquidity of that inventory. So you calculate this by dividing the cost of goods sold by average inventories. And this is something where you're not always given the cost of goods sold results. If you're looking at financial statements, trying to find the figures to plug into your formula, this is something where you need to understand how to calculate it. So the rate can be expressed again in times or days, and it's that same process in order to convert it from times to days. So a high turnover of inventories, so a higher number of times or a small number of days, suggests the business's inventory is fast moving, or there could be a lack of inventory for sale. So this is a little bit double-sided, where in general, you probably are going to assume that this rate would be good because the inventory is moving fast. But you also do need to consider that idea that maybe there's just not enough inventory to begin with. So it's not moving fast or slow, it's just not there, which isn't a good thing because it suggests that maybe the business hasn't got very good systems with stock takes, understanding supply and demand, and things like that. So a low rate indicates, on the other hand, that the business has potentially slow-moving inventory, or it has a large quantity of inventory on hand waiting to be sold, which is a problem because you want things to be moving quickly. You want to be making use of your storage space for things that are going to generate money quickly. If you've got things in storage that aren't being sold for a long period of time, then that is wasting your asset of your warehouse where things are stored. And it's also particularly problematic when you've got things that can go obsolete or can spoil, like food can spoil. So a low inventory turnover for that is problematic. And things can go obsolete as well. So that means that it's no longer the latest thing, it's outdated. So if you think of a phone, there's lots of new phones that are released every year. So if you've got phones from years ago still in stock, then they may have become obsolete because they're outdated and new, better things have been produced. So there's a few ways that you can improve this. So you want to promote some higher inventory sales. You want to potentially discount the sale of those slow-moving inventory items so you can get them out of stock. Make sure that you don't buy them in future if they aren't going to sell quickly enough. And you also want to maintain the stock of those popular items so you can meet the demand that's there for that.